In this video, we're going to do our typical breakdown of our earnings model ahead of tonight's Alphabet release. But for Alphabet, it's a little bit different than some of the other companies we cover because management doesn't give explicit earnings guidance. They just give some general comments on a couple of items on the income statement. So it's a little bit more difficult to do the comparison between management's guidance and consensus estimates. So we'll go through the items that management did talk about last quarter. And then we'll also discuss our estimates that we use to get back to the top line revenue consensus EPS or consensus revenue estimates and the bottom line consensus EPS estimates. So in regards to the guidance that management did give, if you're interested in just listening to those comments, they're about 16 minutes in to the fourth quarter Alphabet earnings call. They talked about revenue, OPEX, and Capex. For revenue, they said they expect the typical seasonality. So in the first quarter, there's always a bit of a decline in revenue off the higher revenue base in the fourth quarter, which is benefited by the holiday season. And then they did say that the strength of the U.S. dollar would continue to impact results, so no surprise there. For OPEX, they said that they're going to continue to invest in long-term opportunities and in the other bets category. So obviously nothing that you can really hang your hat on, and that's to be expected. For Capex, they reminded everybody that the Capex is primarily related to Google business still, but that other bets would be driven by Google Fiber investments in 2016. And there are also a number of other things that they're investing in, the cloud infrastructure. There's so many things that are going to go into that Capex number. But so those are the general things that they gave us to think about. So now we're going to go through our model, and if you'd like to download it, it's available for free on our website, gutenbergresearch.com. You can click on the Models tab, and then just scroll down to the Alphabet model, which is actually the first one after our equity risk premium estimate. And if you just click the icon, it pops right up. So then you can follow along, or you can plug in your own assumptions. So there are two other things that management did mention on the fourth quarter call that we had to think about in this model, and we're going to get to them a little bit later because they're lower in the income statement. But just to quickly remind you, so other income was actually an other expense of $180 million in the fourth quarter, and that was due to a write-down of securities that were received from the sale of a business. So that's not going to be a recurring item, and you'll see that we've made an adjustment for our other income expectations in the 2016 year. And then taxes, there was a resolution of a tax audit in the fourth quarter of last year. And they also had the full year impact of Congress's decision to make the R&D tax credit permanent, which was also ran through the fourth quarter results. So the effective tax rate in the fourth quarter is actually not a good metric to use going forward. So we actually left our tax rate at what we think is a more accurate historical normalized tax rate. So you'll see that as well. So with that, we can get started on our model. So the most important thing to remember when you first start modeling Google's earnings is that the top line, the revenue line, is reported both gross and net of traffic acquisition costs. So every quarter we see on the comment boards or even in some articles, somebody will always compare the final reported gross revenue, so gross of traffic acquisition costs, to the consensus estimate net of traffic acquisition costs. So if you do that, then it looks like the company beat by a couple of $1 billion in revenue. That's not the case. So just make sure that when you first look at the results, that you're not comparing the final gross of TAC revenue number to the consensus net of TAC number. And there's also a consensus for gross TAC as well. So just make sure if you see a large discrepancy in your consensus estimates relative to what the company actually reported, that's probably the confusion. So we originally showed it net of TAC, and then we actually added this little section at the top just to kind of clarify what exactly everyone was looking at. So hopefully that helps out a little bit. So we have our model calibrated to meet the net of TAC consensus revenue estimate. And the way we get to that number is we've split out the two reporting segments. So we have Google segment up here, and then we have the other bets down here. And in the Google segment, we have the Google website business, the Google network members websites business, and then other Google revenue. So those three primary categories. And then we just apply a simple quarter over quarter growth rate to each one of those to come up with our revenue for each one of the individual Google segment businesses. And then you can see that we do give some statistics after the company reports on paid clicks and cost per click, but that's more to inform the future. So we're not actually putting in arbitrary click numbers here, because the company doesn't actually report that, so it's you kind of lose a little bit of the transparency. And we just wanted to keep this model somewhat simplistic. So that's an important thing to remember there. And even though we don't have the paid clicks and the cost per click in the future periods, which are would otherwise be used to forecast your future revenue growth rates, you can still use those estimates and those trends that you've seen in the past to kind of inform your decision of what the revenue growth rate should be. So if you think about it, if you kind of look here, like cost per click of down 8% last quarter, kind of looks like a standout metric, but just keep in mind what that was actually related to. So that's the continued improvement in relevant advertising. So it's caused by the denominator, which is clicks in this equation, to grow faster than the numerator, cost. So it's really just the new TrueView ads on YouTube, which will likely continue in the future and drive the cost per click down. So you can see the trend is going to kind of continue. And that's why we've ultimately left our revenue growth rates somewhat consistent with what we saw for the 2015 year. And you can see we used a similar kind of methodology for the ad revenue from Google Network member websites. So we saw down 4% in the first quarter of last year. We have down 4% in the first quarter of this year. Up 1%, up 1%, up 2%, up 2%, and then up 12%, up about 9%. So not exactly in the fourth quarter, but pretty close. And then we follow similar trends for the other revenue segment as well, which has less meaningful impact on total results. So obviously it's really the ad revenue that you want to focus on from Google websites here. Then after that, you can move down to other bets, and you can see that there is some revenue contribution from other bets, but it's not. It's at a negative operating margin, and this is really not all that significant when you compare it to total revenue. So we just applied simple, basic rates of growth. So nothing too extraordinary going on there at this point. And then below that, we have our explanation of our traffic acquisition costs. So it's broken out between true TAC and other costs to revenue. And our TAC, if you look back through history, last couple of quarters, it's stayed pretty constant at about 21.3%. So, we've got it at 21.2%, and it's just taking the average of the last 3 quarters. So there's not a huge mystery in what that number is going to end up being. And then the other costs to revenue, we also kept fairly consistent with historic results. So if you think about where that brings us to on the income statement, let's scroll up here and get grounded again. So we did total revenue based on the growth rates that we described, and you can see that it's just pointing to that equation. It's just pointing to the 4 different, the 2 main segments and the 3 sub components of the Google segment. So just 1, 2, 3, 4 gets you to your total revenue. And then the traffic acquisition costs is just TAC, which is down here. And then you have other costs of revenue, excluding TAC, which is right there. And that gets us down to our gross profit. Now let's take a quick break, and then when we get back, we're going to go through the rest of the income statement, the non-GAAP adjustments, and then we're going to talk about the share valuation ahead of tonight's release. Okay, so the next items in the income statement are the OPEX items, so R&D, sales and marketing, and general and administrative. And for that, we can scroll down to the ratio section of our model, and you can see that for each one of those 3 items, we set them at a percentage of revenue in the future periods. So R&D, sales and marketing, and G&A as a percentage of revenue. So you can fill in these estimates, and if you scroll back up to the income statement, you can see that this equation is just taking the total revenue and it's multiplying it by the estimate here. So now let's take a look at what we use to get back to those numbers. So skip R&D for a second, because that's the largest one. So sales and marketing, it tends to stay pretty consistent around 12% throughout the year. There's a little bit of a fluctuation. September comes down a little bit, so we kind of tried to introduce that seasonality as well. So it's, pretty much flat at 11.5%, then a slight dip, and then an increase in the fourth quarter. For general administrative, that one also stays pretty consistent, but when you have the higher revenue bases in the back half of the year, it tends to come down slightly as a percentage of revenue, which is what we've reflected there. And then SG&A, we used to back into the OPEX, the total operating income that we are looking for to get back to that consensus EPS estimate ultimately. So that's how we sort of estimated these numbers. And you can see that this is a number we backed into just because if you look at it, it's carried out several decimal places. So the reason it's carried out that far is because we used the goal-seek function in Excel to get back to the final EPS number. Then from there, on the income statement, scroll back up, get grounded again. So that gets us down to total operating expenses and operating income. We're going to leave the non-GAAP adjustments for the time being. So interest and other income and expense. So if you take a look at the fourth quarter, historically it's been, on average, it's been about 157 million of income. In the fourth quarter, it was a loss or an expense, of 180 million. And that was the one item that management did discuss and point out. So that was the write-down of securities that were obtained through the sale of the business. So obviously that's not going to be a recurring item. So when we did our estimate of interest and other income as a percentage of revenue down here, we just took the fourth quarter out of that average calculation. So if you drill into the cell, it used to be a 3-quarter average, but it wouldn't have made sense to include the fourth quarter, which had those one-time events that are not going to recur in the future. So we just took that 1 quarter out of this average. And you can see that that gives us a more normalized other income as a percentage of revenue estimate, and that gets us back in line with what we were seeing prior to the fourth quarter of last year. And then the next item on the income statement is the income tax expense. So we had a similar item or a similar correction in the fourth quarter of last year. So as we mentioned, there was the resolution of the tax audit and the full year impact of Congress's decision to make the R&D tax credit permanent, which all came in the fiscal fourth quarter. So just like with the other income, we didn't want to have that quarter influencing our total effective tax rate. So rather than including this, so you can see the effective tax rate for the fourth quarter was about 5%. So we left it at 20% throughout the rest of 2016, which is a little bit more closely aligned with the historic normalized effective tax rate. So that brings us to the bottom of the income statement. And then the final thing we need to discuss is the non-GAAP adjustments. So for Google, they take stock-based compensation out of cost of revenue, R&D, sales and marketing, and G&A. So we have a new non-GAAP gross margin, operating margin, and net income. And they also adjust for the tax impact of the stock-based compensation. So the way that we calculate this is we do, first what we do is we take total stock-based comp as a percentage of revenue, and we apply the same average that we saw over the last 3 quarters to the future estimated revenue. So that gets us to stock-based comp of 1.4 billion for the first quarter of 2016, which is in line with what we've seen over the last couple of quarters. And then we allocate it to each one of the 4 cost items just based on the same allocation that we saw throughout the year of 2015. So you can see that we've allocated a portion to cost of revenue, to R&D, to sales and marketing, and G&A. And then we apply a similar tax rate to the stock-based comp that we saw in the past. So again, this is a historic effective tax rate on stock-based compensation, and we apply the same historic rate to the new stock-based comp adjustment. And then once we have these estimates in here, you can scroll up to the income statement, and you can see that for cost of revenues, this is just pointing to the stock-based comp estimates down below. And then if you look at the OPEX items, same thing. It's pointing to the 3 allocated OPEX items for stock-based compensation. And then we have the net income adjustment, which is the non-GAAP tax impact of stock-based comp. So once we put all those in, we can get to a non-GAAP EPS estimate for Class A and C shares of 7.97. So these orange cells here represent the fact that we have calibrated this model to meet consensus estimates. And, based on these trends that we've seen over the past year, we think that these are reasonable estimates heading into this release. Next, let's cover the valuation. So if you scroll down below the segment details, you can see that our Google model is actually a Tier 2 model, which means we are not providing a discounted cash flow valuation, just a market multiple valuation. And we're using the next 12-month consensus EPS estimate to create a price-earnings ratio that's calculated on an ex-cash basis. So we strip the cash out before we make this calculation. And you can see that over the last 3 months, shares have traded at an average of 19 times that PE ratio, at a high of about 20 times and a low of 18 times. So not a lot of variability in the price-earnings ratio for this company. And we've set it at the high point, so shares are trading at about $778 per share, which is about 20 times the next 12-month consensus EPS estimate. So when the company reports results tonight, we're going to update the March quarter. If there's any real guidance, we'll kind of tweak the estimates in the next couple of quarters, and we'll leave this multiple the same, and we'll see what the impact is on valuation. If you'd like to download this model and play with some of the assumptions, you can stick to the blue cells, and it makes it pretty easy. You just change any of these blue cells, and you'll see the impact instantly on total earnings and valuation overall. And be sure to check back after the release when we update this model. And if you're interested in financial modeling, please subscribe to our YouTube channel. And good luck with tonight's release and the rest of earnings season. Thanks for watching.